Michael Carnevale is branch manager and financial advisor. Securities offered through Raymond James Financial Services Incorporated, 400 Southbridge Street in Auburn, Massachusetts, 1-800-657-9126. A member of FINRA SIPC and are not deposits, not insured by FDIC or any governmental agency, not guaranteed by Webster 5 Cent Savings Bank, and subject to risk, may lose value. Webster 5 Cent Savings Bank is not affiliated with Raymond James Financial Services Incorporated. The information contained in this report does not purport to be a complete description of the securities markets or developments referred to in the material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Any opinions are those of Michael Carnevale and not necessarily those of RJFS or Raymond James. Expressions of opinion are as of this date and are subject to change without notice.
Good afternoon, ladies and gentlemen. Welcome to the Long Hill Report, conversations with Mike Carnevale, who will tell us today where the puck is going to be. In words of Wayne Gretzky, you don't go to where the puck is now, you want to know where it's going to be. The future lies ahead. You can quote me.
Okay.
Welcome, Mike.
Thank you.
So,
Gotta find the puck first of all. I've lost it actually.
Oh man,
Yeah.
Mike, I told you.
I know. I know.
Well, Mike, this is the worst. September.
Yes.
We expected it to be bad.
Right.
Did we expect it to be this bad?
No.
Okay.
Historically, September is the worst month of the year for stocks, and it didn't disappoint this year. On average, it fell, around 8%, depending on what index you look at it, to the lowest level it's been since November of 2020.
2020. Okay.
And we finished the Dow under 29,000. You may recall it peaked in the first of this year at 36,000. So we've lost 7,000 points. And if you look at your statements, it feels that bad.
Yeah.
But it's actually worse.
Oh,
Yeah.
the harbinger of bad news.
Of bad news. Get all the bad news out in the first
Mike, get it out
minute or
now.
two. First time since, I believe, 2009, where the first 3 quarters of a year have been all negative. And where I think people really feel it this time around, because there's an index, they call it the 60-40 index. In other words, 60% stocks, 40% bonds. Historically, that's where you should be, so they say, whoever they are. And that's at its worst performance since 1931. Usually when stocks are having a tough time.
Wait.
Yeah.
1931.
Yes. Yeah.
Okay. Let me catch your breath quickly.
Yep.
So what does that mean?
Well, what we've had this year is, obviously we know the stock market has done poorly. Usually when the stock market does poorly, the bonds do pretty good. But unfortunately, the bonds have done equally as bad. So your stocks are down, your bonds are down. There's nothing to sort of cancel the other one out. So instead of, usually if bonds are down, stocks are up. If stocks are down, bonds are up. So there's sort of like a cancellation effect of some of the decline.
Right.
So far this year, they're both down pretty substantial. And that makes it the worst since the early 30s.
Do you, you've just given us the bad news.
Mm-hmm.
What do you say overall that means for the economy, that we're really in bad, is this leading anybody to use the R word?
Well, I think
recession.
Sure. I think people, recession, it's funny, when you're in a recession, you're already out of one. It's because it's sort of a lagging type indicator.
Like in the 1930s, they used the D word then.
Right, yeah, that was...
So that was
right.
30, and so anywhere from 1929 to, say, 1940, that we know we were out of one?
Right.
But took us a long
It
while.
took a long time, yeah. I mean,
Okay. So,
I
I
think
mean-
things are different now.
You think this is not, you think, okay.
Not the beginning of that.
Nobody has said the R word. I mean, everybody has said it, but nobody has said, yes, we're definitely in one.
Right.
When are they going to say that? Or are they?
Some will never. You know, right now, the Republicans are saying we're in a recession. The Democrats are saying we're not. Why? Because it's to each one's advantage coming up into an election.
Obviously.
There's a lot of indicators that say we are, but there's also a lot of indicators that say we're not. You know, will those indicators that say we're not in a recession at some point say we are? Yeah, anything's possible. But I don't think right now it's there. You know, the Federal Reserve, you know, has been steadily raising rates by 0.75% every 6 weeks. They're going to meet, excuse me, they're going to meet again in the 2nd of November, probably going to do it again. At some point, that will cause a slowdown in the labor market. That could cause an indicator to indicate a recession. But by then, the other indicators may be starting to recover. So I think it's kind of a peculiar situation in that, you know, it's not like 08, 09 with the housing crisis, and it's not like the time where we had the financial crisis when Lehman Brothers went under and Bear Stearns went under and Bank of America had a bailout, Merrill Lynch. It's not like that. It's more a function probably of too much stimulus money and now a rapid taking away of that.
Well, we haven't heard too many big names in trouble like Lehman and
Right.
things like that.
Right.
We have heard recently, I think it was Credit Suisse,
Correct.
has a lot of derivative counterparties.
Right.
And they're screaming, you know, they're begging for help.
Right.
So if that blows up more than it is now,
Yeah.
do you think that will be the
That
thing?
would be a very big negative. However, the latest news is the Swiss government's probably going to allow UBS
to take over
to take
credit?
them over.
And you think UBS has enough to, you know, unwind the derivatives?
Well, it'll probably, I think it probably, you don't know, but it'll probably make it a little better. You know, I mean, we're not involved in that, so it's hard to say what.
Oh, yeah, well, somewhat.
Oh, I mean, me personally. So,
Okay.
I know
I'm not personally.
Okay. All I know is what I see. It probably would be enough, especially if the government's gonna. I mean, you got to remember back when Lehman and Bear Stearns and Merrill were all in trouble. I mean, the U.S. government essentially bailed them all out at the last minute.
How did they bail them out?
Well, they allowed the merger to take place and allowed money to back up some.
Printed a little money
Correct,
down there,
yes.
down in the
Backed
cellar.
up.
Yeah,
Don't want to go that to those.
there was Ben Bernanke down there.
Right.
He had the little shade on, and he was running
Backed
that
up.
printing
Right.
press.
So I don't see why the same wouldn't happen in Switzerland.
Well, we did, you know, like Deutsche Bank, and we did provide money for them.
Right.
Will we not provide money to UBS?
Probably
If we
would.
had-
Probably would.
At what point does this not work? Or will it always work forever?
I always believe that as long as people want things or believe in things, it can go on forever. It's when there's no buyer, you know,
And that is true.
and it's in nobody's advantage to have no buyers. Because someone says, "Oh, well, they'll let it all go down, and there'll be this one that'll pick it all up." No, it will affect everybody. So I just don't.
I agree and I don't agree. In that, most people will say, you know, putting the Titanic right in the path of the iceberg and letting it sink solves some problems in that you don't have to worry about the Titanic again.
Right.
But that the cure is kind of worse than the disease for the upper middle class anyway. But for your average walking around person, the decline is going to continue if we continue to bail out everybody.
But it's all cyclical. I mean, you know, it was funny. I was looking back at a at a newsletter that I write for customers. It would have been 2 years ago. 2 years ago this week, the Dow crossed 29,000. And President Trump tweeted the Dow was up 300 points. And he said, wow, he said, Dow over 29,000. Great leading indicator. Let's not ruin it with Sleepy Joe. So, yeah, we're, okay, 29,000. We're at 29,000 again today. Suddenly it's economic disaster. It all depends on what side of the fence you're on. I mean, 29,000 is great. Here we go. 29,000, oh my God, 29,000. It's, so I mean.
But wait, you know, it got up to what?
36.
36. So, going from 36 to 29, even though Trump is not there. And,
right.
If you're looking at your statements,
Yep.
and you look where you were.
But was 36 an extreme? Everything goes to extremes, on the negative and on the positive. Was 36,000 an extreme? Maybe it was. But nobody cared because they looked at their statement. They said, "Whoa, boy, look how much money I've made." Well, you haven't made anything because you haven't cashed it in.
Well, right, but I'm sure you know, in your clients and everything, it's always going to be, what have you done for me lately?
Oh, trust me. I wish I had people who said just that. Unfortunately, it's been a little stronger than that. Like, we control anything.
Yeah, right.
You know, I mean, you know, investing right is a long-term process. It's ups and downs.
Well, what else can you do? I mean, if you're a person in some situation, whether you have IRAs, 401ks, or a pension plan at work or something, where else can you go? I mean, maybe you can find some Shangri-La way out in the wilderness in upstate New York.
You probably would be able to.
That's one thing, and you know, you brought a lot of those survival foods and stuff like that. But otherwise, what choice do you have?
You really don't. But it's not what people are doing on the investment side. It's all of the other stuff they're doing that maybe they shouldn't be doing. Such as, oh, the market's doing real good, so we can over leverage in some other areas because, see, this keeps going up. I think that's where people run the risk, sort of living beyond means.
Well, I certainly have never done that.
No, of course. Well, I'm not saying you didn't, but there are supposedly some people who do that, and I think that's where it, you know. And then you got to find someone to blame. So the government is always the easiest, or the perceived people who are big shots, Wall Street, the government. It's easy to blame them when in reality, you know.
It's you.
You got to blame you. You got to blame yourself, and a lot of people don't like to do that.
I love to. I mean,
yeah. Well, I could tell. Yeah. But I think that's the key. So, you know, 2 years ago, 29,000. Hey, great, wonderful. Oh, this is great. 29,000 today. Oh my God. Oh, this is a disaster. It's the same number.
Okay, I think we have to look at some of this stuff.
Yes.
Let's go down to the technicals.
Well, You know, one thing about the technical indicators, the good thing about those is they can allow you to sort of remain sort of balanced. In other words, keep expectations in key. Technical analysis is a great indicator. In trends, it just can't pick the exact time that something's going to happen. So the technical indicators, they're unbelievable in the last 3 or 4 weeks. I mean, which would tell me we're going to get some type of a good upswing here. Don't know if it's tomorrow or next week or next month, but in comparison to where we've been, we are going to, the indicators are saying we're going to get that. And we did have that Monday and Tuesday of this week. The first 2 days of October, the market was up 1,500 points, or almost 9% or so, or no, 5% or so. And then it's dropped off a little since then. But I'd say better that chance we see an upswing as opposed to another big downturn, at least on the technical indicators. If North Korea decides to turn the direction of their missile, well, the technical analysis will not pick that up.
Yeah. So I remember one person in early 2011 saying, we're going to have a short, sharp recession, but then everything will be great. Mm-hmm. Before 9/11, they said that.
Correct.
So yeah, there's some things you cannot predict.
Correct.
But like the VIX is 32 versus 25.
Right. Anything over 25 is considered very positive.
So, but that means there's less volatility.
No, that means there's a lot of volatility.
A lot of volatility, but less than 25 a month ago.
Correct.
So
volatility is increasing, which is good as a positive.
Stochastic oscillator.
Right.
Which is, you can get a degree just being able to pronounce that.
Correct.
Price in relationship to its support, now at 11 versus 16 a month ago.
Yep. Anything under 20, it historically shows that the market is really oversold, meaning that it's ripe for some type of a rebound.
Okay. Fear and greed.
Well, that's a CNN indicator, which groups together. It's sort of a marketing thing for them, but it groups together, I believe, 7 different indicators, and they have a proprietary formula how they mix it all together, and it comes out with a number. But it's at 16, and anything under 25 historically has been an period of extreme fear by people. And what do people do when they're worried? They sell out. Let's sell all out, and we'll buy in when it looks better. By then it's too late. And a lot of people don't realize, now, I'm hearing people saying, real estate, I'm going into real estate. Real estate is this, that, and the other thing. And, I'll say to someone, well, do you know that from 2006 to 2011, every quarter in those 2 periods, the average value of a single-family home fell?
Say the time frame again.
From 06 to 11, every quarter, the average price of a single-family home fell.
Wow. And what's happening now?
Well, they're starting to go down a little bit now. But I say, so you must have sold your house during that time, right? Because you want to sell your stock portfolio today because it's going down and get back in when it looks better. So did you say, I'm selling my house because it's going down in value and we'll rent until we see things get better? Then we'll go back and buy a house.
Well, that's a much different thing. Do you own a house?
Yes.
Do you like living in it?
Sure.
So even though the value goes up and down, that's where you live.
But you don't see it going up and down. because you don't get a monthly statement on the value of your house.
Well, true, but
So if you
but-
didn't see it, you probably didn't realize it. Or if you realized it, realizing and actually seeing it on a sheet every single month, I think is a little different.
Yes, that is a good point in a way, but I mean, you just brought up, you don't say you're going to rent or anything
Right.
like that. Sell and rent and then come back into it.
Right. So why do you
Because
want to
there's-
do it?
there's so- well, there's much, there's a lot of costs and in selling a house, buying and selling houses.
Yeah.
It's a much bigger process than going on your computer and saying, let's move out of stocks and into bonds or from bonds into stocks.
Right. But
So the immediacy of one is different from the time lag in the
yeah.
other.
But I still look at it as you didn't sell this asset because it was going down and buy back when it recovered. Yet another type asset, you want to do that. To me, it doesn't make sense. Because that sounds great. Make a note. Sell low, then buy when lower. But what happens is you sell low, it starts to recover, and you say, well, I can't buy now because it's going up. I'll wait till it drops again. And there were people who bailed out in '08 and '09,
On the stocks.
yep, who have not gotten back in yet. And that was in March of '09 when the Dow got down to 6,600. And they say this, and we have people like that who say the same thing. Well, let me know when you got something good. You've missed five-fold increase, or four really, because you wanted to get out when it was going down. And that's all based on letting your emotions take control. And that's what those technical indicators try to help you.
And it's very obvious they are fear-driven.
Right. Right.
And it's fascinating because, you're basically saying, all these basically say, how scared are people?
Right.
And I should be braver.
Correct.
And so there's got to be a heck of a lot of people out there who are not following the Carnevale plan.
Majority of people, because they do studies that show what the average. I believe it was a Lipper or Morningstar. One of those agencies did a study on how people performance is versus an index, and people way underperform because they try to time things. They try to get out, they try to get back in, and they get back out again. And if you're always selling when it drops and buying after it recovers, and you live long enough, just from a math perspective, you'll end up at zero.
Probably. I
Right.
think that's probably true.
So
it's major news time. I'm not going to be the skunk at the lawn party and mention that OPEC has said we're cutting 2 million barrels.
right,
But that is something to consider.
it is.
The Fed raised rates still, but we have other countries that are also hiked,
Just about everybody has.
other than Turkey, but
Other
they've always
Turkey.
been kind of bizarre
Strange outfit there.
about that. Would you say Japan with negative rates? Is their rate less than zero?
It is, yeah. It's the only country now that has a negative interest rate.
Wow.
And there was a time it was Germany, it was Switzerland, it was a lot in Europe and a lot in the Far East. That's all flipped now. Japan is the only one. It's a negative 1/10 of 1%.
And we see that $75 a barrel rig count mixed in September, 12 billion barrels per day production. OPEC talks production cuts. We'll
Right.
see how that affects.
And that's
our-
already affected because
Yeah.
oil today, as we talk, is like 86.
Anyway, let's get to the science.
Okay.
Red Sox clinch last place.
Yes, that's the only good news. It's the only good news.
You're lucky you don't get hung in Boston. I'm telling you.
It's the only
In the AL East.
the only good news, because it hasn't happened that often, but every time it does, the following year is pretty good for stocks.
Okay, everybody, go out there and buy and
Get
just
get everything bought before the beginning of April of next year.
All right, so inflation, mixed results, total down, core still up.
Yep.
Consumer prices up 0.1.
Yep. Yep. Down from a month ago, but the number that the Federal Reserve watches, which is the core number, has been still going up, even though total inflation has been dropping. So that's a bit of a concern. And the core takes out the food and energy. So those are the ones that have really been going up. And when you subtract those, inflation's going up even more. So it shows that, you know, what's happened with food and energy has really crossed over into just about every other thing. And that's what I think is, at least the Fed says, they're worried about. And that's why they keep saying they're going to keep raising rates a lot.
Yeah. And how well that will make the world, because that's another thing that could push you into the R word.
It could.
All right. Leading economic indicators down 0.3%.
Down, I mean, it's the fifth month in a row negative. Usually 3 negative months would signal the start of a recession. It's getting better, meaning the declines are less.
But it's still declining.
It's still a decline,
And
yes.
why is nobody saying that?
I don't know. That's a good question.
Well, maybe it's because the jobless claims. Maybe they're saying, "Oh, isn't that wonderful?"
Yeah, jobless claims are under 200,000, which is kind of surprising. Excuse me. Although the latest number shows it increasing again. So, maybe inflation and higher interest rates are beginning to affect the job market. We'll know this month when the employment report comes out for September.
Well, yeah, that is something to watch, because this isn't bad from what you're saying.
It's not bad.
But if it goes south a little bit even,
Correct.
then panic might set in.
Correct.
In certain circles, not us.
Not between us, no.
Anyway,
Outside our listening area, as they say. Our viewing area, right?
viewing and listening.
Huh?
Viewing and listening.
Yes,
We
yes.
do have sound here.
Oh, okay.
We haven't brought in the American Sign Language person.
Not yet. Okay.
And there is,
We don't want anybody giving hand signals.
especially as if the economy goes bad.
Correct, the way the
some of-
market is
some of
going.
some of those hand signals are
Yes, we will.
not things we have in polite company.
Correct.
Which is what we observe all the time.
Absolutely. Absolutely. It's only when the cameras go off that a rumble starts.
So, you're saying, but you still have your basic confidence. I mean,
Yeah,
Mike
I do.
Carnevale always says, never bet against the economy of the
Yeah.
United States.
And that isn't, and we're talking never bet against the economy, has nothing to do with the government or who's in power or not. And I just, first of all, investing is long term, right? So you have to realize that you got to take, if you want the good, you got to take the bad. If you don't want to take the bad, then you have to go to something that won't give you a bad. And that would be something that has a fixed interest rate, like a CD or maybe a money market fund where it can never go down. So every day you can look at it and you have something more than you had the day before. Unfortunately, if you do that over the long period of time and you factor in inflation, you're actually going backwards. You just don't realize it. And so I really put a lot on the technical indicators to kind of keep you on even keel. I mean, no, I don't like what's happened to forget about everybody else's statement. I don't know what happened to my statement.
Yeah, well,
But-
we
but-
all.
Right? But then I say, okay, these are the reasons why. Yeah, September's usually historically a bad month. You know, I don't get excited when it snows in January, because usually it does snow in January. Maybe sometimes you're pleasantly surprised, but usually you're not. So keep emotions under control. Look for the long term. You know, a lot of times people will say, you know, I'll say to people, you ever hear somebody say, and I may have mentioned this to you, you ever hear somebody say, geez, how did they make all their money? And usually it's something like, oh, well, they were buying this when it was really bad. And that's my philosophy.
Well, sometimes, I mean, yeah, that works. I mean,
We're talking quality. I mean, we're talking buying quality,
Well, I
not
mean,
speculating.
how did Steve Jobs make all his money? Well, he invented something
Right.
with another guy.
Right.
Yeah, so
Right.
there are those, you know, most of us, though, in this life have to be, if not passive investors, at least, you know,
Correct.
have to, like you're always saying, long term.
Yeah.
So,
When something's on sale, do you buy more of it, or do you say, forget it, I'm going to come back when the sale is over? I mean, investments are the only thing people won't buy when they're on sale. They'll go nuts for a sale. Not in investments. No, it's bad. If it's on sale, it's got to be bad.
well, most of us, and I include myself in that, really don't have the depth to do that. That's why things like index investing are the way to go.
And that's fine. So you would add to your index investments.
But that's
during
not
bad times.
really ever on sale.
Sure it is. The index
Okay,
is
it's more
30
up or down.
Yes, the
yeah,
index
but
is 30% lower today, or 20% lower today than it was at the beginning of the year.
well, in the words of, who is the guy, Peter Lynch?
Yep,
Sometimes it's darkest just before it gets pitch black.
that's right.
So, you know, it's, in the words of Ned Ryerson, did you ever see the movie Groundhog's Day?
No.
Great movie, you need to see
Okay.
it. It's all one big crapshoot, anywho.
It is true. It's true, right? There's odds I won't get out of the parking lot tonight. It's probably less than
Hang
one.
down there after you, I think.
Maybe it's less than 1/10 of 1%, but there is an odd to that.
Ladies and gentlemen, we
With that
have
happy
been
note.
privileged to have Mike Carnevale, and it has been a great half hour, roughly half hour.
Right. I would agree.
And we've been fortunate to have our facilities manager, Drew Anderson, guide us through technically.
He hasn't left yet?
He's trying to get out of here,
I
but we
can see
chained
that.
him. We changed
Yeah.
him to his seat,
A lot of hand signals I see.
and he better stop that. All right, thank you very much, ladies and gentlemen.